Nothing beats sitting back, sipping a cold one, watching Finance Squared on YouTube, and waiting patiently for the money to roll in because your investments are on autopilot. In other words, true passive income. Now, there are many times in life when it pays to be active, when you're trying to get and stay in shape, when you're streaming a video game live, when in a tap dancing contest. When it comes to investing, however, a more and more popular methodology is not to be a day trader, parsing complex charts, scouring the earth for market making tidbits, but instead, the smart money is on taking it easy. We'll take a look into some strategies that employ that mentality using index funds. So, gently, lovingly, tenderly caress that like button for the YouTube algorithm, and let's dive right in. But before we do, you're watching Finance Squared, and I'm your lovable, affable, bearded host, Derek West. If this is the first time here, welcome in. We'd love to have you. But if you're coming back, glad to have you back. You know how we do it here, and in any case, let's dive right in. So you should be saving your money and using it to invest. But the problem then becomes, how? How do you do it? The amount of know-how to be able to do that effectively without losing your shirt seems almost excessive. Will you be forced to follow the markets all day, every day, looking for every morsel of information on individual markets to be able to time when you get in and out of certain investments? That could require a significant amount of time. Other investment vehicles require tons of time as well. No matter what anybody tells you, real estate is a massive time sink. And while that is true that in the long term you can really build a ton of wealth, in the near term, short term, etc., if you're new, expect to pay a ton out of pocket, plus spending nights and weekends, whenever you have free time, either following up with contractors or putting in a little sweat equity of your own. Again, that's fine for some people. And in fact, that's a pathway that I'm looking to get into pretty soon. But what if you really just want to take it easy? Well, how about franchises? Yeah, you can save up the cash to get one, including the money it will take to get, primo real estate location in a high traffic, high growth, depending on the franchise type area. And that can be very lucrative. But what if you only enjoy sipping on lattes and not making them? What about options, derivatives, or Forex? Well, those can be even riskier than just general stock trading. Now, I did a video about those exotic investment types. Check the link in the description or in the bar above and, check those out. But they all require time. Time to, understand what the heck you're doing. B, find the right investment instrument and the timing to get it done correctly. And C, ruthlessly execute with cold-blooded efficiency. And again, that just takes time. Time that none of us really has. Unless, of course, you're already a savvy day trader or have the bank for real estate or the bucks for franchises. What about the rest of us that have other things to do with our lives? Are we doomed to not be able to retire? Or do we have to build wealth in our spare time studying charts and graphs and watching market metrics and market moving events? Do we have to become handymen, working nights, weekends, whenever we have free time, fixing up rental properties and fixing toilets and water heaters and other appliances as landlords of the said property that we're renting out or that we're flipping? Well, a lot of people are not going to tell you the truth on this one. But the bad news is the answer is yes. If we want to build large fortunes and accelerate our wealth beyond our wildest dreams, we need to put in the sweat equity to get there. But hold on one second, buddy. Don't despair. The good news is that if we want to grow our income passively as we're putting in that sweat equity, there is a way to do it. You can invest and have a life also. The question is how. There are a couple of ways to do it, honestly. And today, we're talking about just one of the more popular ways, and that's using index funds. On this channel, we've previously discussed ETFs. Check it out in the video card above. And make sure you're subscribed with the post notifications turned on so that you get more videos like this on topics similarly, because we have more videos on ETFs coming out in the near future, so stay tuned. But the topic of this video, specifically index fund strategies, is a way to legitimately earn passive income. But why index funds, you may ask? Well, to answer that question, first you need to understand what they are. Index funds are mutual funds that track the performance of an index. What do I mean when I say index? Well, I'm talking about things that you've probably heard of when watching Market Watch on the internet or CNBC. We're talking about indices like the S&P 500, Dow Jones Industrial Average, and there are several others out there. Why those indices? Well, for example, the S&P 500 has grown on average over 10% per year since 1926, when it was initially founded as, the name of it is different and it escapes me. I'll make sure to include it on the screen right now so that you know what it is. But it has grown on average 10% per year every year. If you were to be invested in a fund which owns all the stocks in that index, you too would achieve that success rate year over year. Some stats for you to consider. Figures from the index fund research and data company Morningstar show that U.S. index funds have $4.27 trillion in assets under management, compared with $4.25 trillion for actively managed funds that have the goal of beating the stock market. Now, an actively managed fund would be what we would normally consider a mutual fund. There are some hedge funds out there as well that employ different tactics than mutual funds, But index funds are a form of passive investing because they allow investors to buy a lot of stocks at once and hold them for the long term. And what's more, they have lower associated costs than actively managed funds. The reason for that being, they're not really attempting to try and beat the market. They're only trying to follow the market. So the work that's required to do that is quite considerably less. Therefore, the cost to you is less. One of the great things about index funds is that they don't require you to be an expert. While professional investors make a living by trying to outperform the market, the strategy is difficult to successfully execute over a long period of time. Famed billionaire investor Warren Buffett, whose stock picks are closely followed, has said that index funds make the most sense practically all the time. That's because though individual stock prices can fluctuate wildly, the broader index has tended to go up over time. And with index funds, you don't have to pick the winning stocks to benefit from the market's overall gains. The S&P 500, an index representing the 500 largest U.S. companies, has delivered average annual returns of almost 10% going back 90 plus years. The past 5 years in particular has been very good to index funds in general, and to the S&P 500 in specific. Even including the pandemic panic of 2020, the S&P 500 has averaged over 7% every year for the last 5 years, and over 10% since 2008. If you go back to the inception of the S&P 500, which was at one point called the Composite Index, according to some random site on the internet, link below, the S&P 500 has returned 10.19% every year. Now, if you would have invested $100 in an S&P 500 index fund in 1926, I know what you're thinking. They didn't exist way back then. But stick with me. You would have $996,000 and 207 cents at the beginning of 2020. And with a greater than 16%, 16.2% to be precise, return in 2020, at the start of 2021, you would have $1,158,074. Not a bad return. That said, you would have had to reinvest all of your earnings, but that would have been one $100 purchase more than 90 years ago. What other things, purchased for $100 in 1926, would have yielded you over $1 million? Not many. Even like a Model T Ford, you still wouldn't have $1 million. But yeah, that is quite simply the easiest passive investment you'll ever make. Another great plus, fees are kept to a minimum. Index funds pool money from groups of investors, and then they buy the individual stocks or other securities that make up a particular index. That model helps to reduce the associated costs that fund managers charge compared to those funds which someone is actively strategizing which investments to include. Fees matter because they can cut into your overall return. Among equity funds, those made up of stocks, the average expense ratio for index funds was 0.08% in 2018, compared with 0.76% for actively managed funds, according to figures from the Investment Company Institute. That works out to about 0.7 cents for every $1,000 invested versus $7.60 for every $1,000 invested. By not paying a lot for someone to pick and choose your investments, you get to keep more money to reinvest in your portfolio. Another great reason why index funds are so popular is that they help you to diversify. With an index fund, the mix of stocks helps to minimize your portfolio's related risks. That means your portfolio's value is less likely to fluctuate wildly because an index like the S&P 500 typically moves up or down less than 1% on any given day. You could buy all components of an index individually, but you'd spend a lot more money doing so. With an index fund, you can get all those stocks with the click of a single button. But even with that click, there are so many index funds to choose from, and it's still possible to lose money when investing in strictly index funds. This is where having a strategy comes in handy. And that's what I call a segue. But in terms of strategies, I'm not talking about a complex algorithm that you need to execute daily to have success. It's more like a set of principles that can be utilized to help guide you as you invest passively. While there are many different strategies out there, they generally fall into a class of strategies called asset allocation, where the investor breaks up where he places his investment based on the type of investment, its risk profile. In other words, stocks versus bonds, where stocks are riskier than bonds but promise higher returns, and the investment horizon of the investor. That's all just finance wizard gobbledygook for how long you plan to be invested in the market, typically represented by when you plan to retire. And yeah, buddy, this is starting to get complex, but stick with me. It gets pretty simple from here on out. Those strategies can be further categorized into the number of funds per portfolio. In other words, the 2-fund portfolio, the 3-fund portfolio, and the 4-fund portfolio. Let me explain. 2-fund portfolios, they're ludicrously simple. Simply follow the 60-40 rule of asset allocation, depending on your investment horizon, that is. 60% stocks, 40% bonds. We talked about your investment horizon a little bit earlier, and to reiterate, that asset allocation split would change as you approach your investment horizon, the end of your investment horizon. The thinking is that as that window closes, or as you approach retirement, you generally want to have more safe funds or assets in your portfolio. And that would apply here as well. But imagine if you're a young gun with $25,000 35, 45 years to go till you envision retirement, whatever that means to you. Then 60% to 40% is the right allocation for you. But maybe you have a riskier appetite. You can up the percentage of the stock allocations to 70 to 30 or 80-20. But anything more than that, and you're risking significant loss and financial stress. Remember, we're trying to keep it lazy and low maintenance and not cause a ton of worry based on market gyrations. But if you need examples of index funds that can help you fill out those allocations, try looking into the Vanguard Total Bond Market ETF, BND, or the Vanguard Total World Stock ETF. There are others out there that are offered by Charles Schwab, Merrill Lynch, and many others. Just be sure to shop around and look for the right one for you. Then there's the 3-fund portfolio. This one is relatively simple. It allows you to follow the 60-40 rule to keep it nice and simple. Wait. Didn't I just say 60-40? That's only 2 allocation levels. How can you follow the 60-40 rule if you have 3 funds? The math simply doesn't add up. Well, with this strategy, they get pretty sneaky. They break up the 60% equity of the asset allocations, and they split it in two different stock classes. Typically, the classes are U.S. stocks and international stocks to help isolate you from localized volatility. In other words, if the United States of America's stock market goes kaput, or if China's stock market goes kaput, or wherever you're invested in the world. A good allocation split would be 42% U.S. stocks, 18% international stocks, and 40% bonds. Like with the 2 funds setup, you would make sure that this allocation follows your risk tolerances. In other words, if you're older, hold a higher percentage in bonds. If you're a real maverick risk taker, hold a higher percentage in stocks. Some example indexes would be the Vanguard Total Stock Market Index, the Vanguard Total International Stock Index Fund, the Vanguard Total Bond Market Index Fund, etc. And then there's the 4-fund portfolio. As a neurologist turned financial wizard and author of The Intelligent Asset Allocator and The Birth of Plenty, Dr. William Bernstein has championed the power of index funds over individual stocks and bonds for years. That stated, he might be a tad bit biased in that regard, but nevertheless, he suggests you put your money into a lazy portfolio that's made of a few index funds. One portfolio that he suggests in the Intelligent Asset Allocator is called the No-Brainer Portfolio, and it's comprised of 4 equal funds: 25% U.S. stocks, 25% small cap U.S. stocks, 25% international stocks, 25% bonds. You can see why it's a no-brainer. This portfolio also gives investors a chance to diversify their risks since there are 4 equally distributed funds over time. Now here are his suggestions for the funds you can invest in. Vanguard 500 Index, Vanguard Small Cap Index, Vanguard Total International Stock Index, Vanguard Total Bond Market Index. And there are more strategies out there. I don't know if you noticed or not, each of these strategies was really just a take on the original 60-40 strategy, with the exception of the 4 fund strategies that we just talked about. But each time, you would split up the 60% among various index funds. There are funds that have been split up into 9 allocations, again with 40% in U.S. bonds, but with an allocation of, let's say, U.S. large cap stocks at 15%, U.S. large value stocks at 10%, U.S. small cap stocks at 5%, U.S. small value stocks. When I say value, I'm talking about stocks that provide dividends at 10%, REITs at 5%, European equity at 5%, Pacific or Asian equity at 5%, emerging markets at 5%, and U.S. short-term bonds at 40%. I'll drop in some names of index funds that you can utilize in the description down below. I'll put down some index funds that you can take advantage of, search for and take advantage of, as well as REITs and other index funds that you can take advantage of to help you achieve this particular asset allocation strategy. But I'm not going to go through all of that. That is quite a bit of a mouthful, and my mouth is starting to get dry. But other portfolios have been broken into 7, and there are portfolios out there with 5, 6, 10, 11, 13 different asset allocations. The key is to keep a little bit of a buffer in the bond allocation at 40% so that you're not suffering if any one of those asset allocations fluctuates too much, and just break up the rest of it into 60% that don't overlap and are ideally separated geographically to help decrease the risk of domino asset sell-off contagion, which it's hard to do because, as we all know, in 2020, the entirety of the market went south, and very few people over that time period managed to not lose anything. But that stated, keep in mind, there are thousands of index funds out there to choose from. You don't have to choose from Vanguard or Charles Schwab or Merrill Lynch as your broker of choice. Pick one that works for you. And I'll just say this is a complex topic. It's probably not that easy to pay attention to something like this. And it's even harder to make a topic like this entertaining and informative at the same time. I'm hoping I nailed it. Let me know if I did a good job or not. Here's hoping that you at least found it informative. And don't forget to like this video if you liked this video. We have other great videos coming up in the weeks ahead, including videos on cryptocurrency, debt reduction, and so much more. That's why you need to hit the subscribe button and enable post notifications so that you get those videos when they drop before the rest of YouTube. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Give yourself permission to succeed by executing your plans for success, starting with an index fund strategy for passive investment. And I'll catch you next time. Peace.